Welcome back to the Deep Dive. Thanks for bringing us this stack of source material today. It looks like we've got reports, news updates, analyst notes, all focused on the Kenyan financial and business markets for today, May 23rd, 2025.
Exactly. And the goal here in this deep dive is really to pull out the key stuff for you, the listener. We're going through these sources to get you the main insights, the important trends reported today, without you having to sift through everything yourself.
Absolutely, like getting the essential briefing straight from the day's reports.
Oh, cool.
So, okay, let's dive in. What's the big picture? What did the market look like overall today?
Well, looking at the summary for May 23rd, the standout number really is the equity turnover. It came in at KES 262.94 million,
Okay.
which is a huge jump. I mean, an 88.1% increase from yesterday's KES 139.81 million. Really significant.
Wow. Yeah, 88%. That's a massive leap in activity in just one day. Did that surge translate into big moves in the overall market value or the indices?
Interestingly, not so much. Market capitalization, it ticked up slightly, yeah, but only by 0.1%. Came in at KES 2,106.46 billion.
Okay, just a tiny nudge then.
Pretty much. And the Nairobi All-Share Index, the NASI, it did close up 0.1% at 133.91. One source did mention this signaled, some bullish momentum.
Right.
But the other main indices, basically flat.
So loads more trading, but the actual market value, the broader indices, didn't really follow suit in a big way. That seems, well, a bit of a contrast, doesn't it?
It does. It suggests maybe that the high activity was quite concentrated, perhaps in specific stocks, maybe ones that weigh more heavily on the NASI rather than being like a broad rally across everything.
That makes sense.
Yeah, because the NSE 10, that's the top 10 companies, the NSE 20 and the NSE 25, they all closed either completely flat or down just 0.0%. So yeah, very little movement there.
Okay, concentrated activity. Got it. And who was doing all this trading today, according to the sources? Locals, foreign investors.
It was overwhelmingly local participation. The sources put it at 89.5% local. Foreign investors made up the other 10.5%.
And were those foreign investors buying or selling on balance?
They were net sellers again today. Net outflows of KES 0.40 million.
Still selling them.
Still selling, yeah. But the sources did point out this was actually a much smaller outflow compared to yesterday. That was KES 1.97 million. So while they're still selling, maybe the pressure eased off quite a bit today.
Interesting. Okay, let's zoom in a bit. Moving from that overall picture to specific stocks, what about individual company movements and what the analysts are saying in these reports?
Right. So that bullish hint in the NASI, it seems it was supported by gains in some of the big names. INM Bank was up 1.9%.
Okay.
East African Breweries, EABL, gained 1.2%, but Take Kenya rose 0.9%, and ABSA Kenya was up 0.6%. So some decent green there.
So I guess other big names must have pulled the other way to keep those main indices flat.
Exactly right. You had losses in stocks like Stanbic Holdings and KCB Group, both down 2.0%. Cooperative Bank was down 0.9%, and even Equity Group edged down 0.1%. So yeah, those definitely weighed things down and balanced out the gainers.
Okay, a real mixed bag among the heavyweights.
Yeah.
And where was that huge turnover happening? Which specific stocks were seeing the most action today?
The top traded counters, that's what they call them, by turnover, were INM Group that saw KES 90.74 million traded.
Wow, explains their price jump.
Yeah. And Safaricom was second with KES 29.78 million in turnover.
Okay. Now, beyond just the day's ups and downs, one of your sources gave specific analyst recommendations, right, with reasons behind them. Let's maybe walk through a few of those.
Yeah, absolutely. Good idea. Let's start with BIA Kenya. Trading price was 395.75 today. The source gives a target price of 436.25.
Right, which suggests, what, about a 10% potential upside?
Just over, 10.2%. And the recommendation is a BUY.
Okay, why BUY?
Well, the thinking is that cost pressures are stabilizing, which should help their margins. They also mention a progressive dividend policy investors like that, and they expect some organic growth from consumers.
Seems pretty positive then. What about Jubilee Insurance?
Jubilee, currently priced at 223.25. The target in this report is 241.97, so about an 8.3% upside. Also a BUY recommendation.
Reasons.
Again, they note the progressive dividend policy. But also, interestingly, the analyst reckons there's a gap between the current market price and the actual book value per share. They think there's room for price discovery, basically, the price catching up to the underlying value.
Finding its true level, maybe. Okay. Diamond Trust Bank?
DTB.
DTB, trading at 48.50. This one had the biggest suggested upside in this list, target price of 54.38. That's a potential 12.1% gain. And yes, another BUI.
And the logic there.
They mentioned things like regional expansion, strengthening their sort of financial ecosystem to boost earnings, plus investments in tech and infrastructure, which they hope will improve cost efficiency down the line. Okay, 3 BUIs. Makes sense. Now, what about Equity Group? We saw they were slightly down today. What's the call there?
Right, equity. Currently 76.25, target price is 85.68, so that's actually a 12.3% potential upside, similar to DTB.
Oh, okay. So a BUI then.
No, interestingly, the recommendation here is Haysaldi.
Hold. Why hold with that kind of potential upside?
Well, the analyst acknowledges the strategic expansion and how they're leveraging improving asset quality, fewer bad loans to support lending and income. But they specifically point to, and I'm quoting here, lackluster return on equity growth. That seems to be the main reason tempering the recommendation.
Ah, okay. So potential is there, but maybe the actual profit generation relative to shareholder equity isn't growing fast enough for a BUI rating.
Got it.
Was there a sell recommendation in the mix?
Yes. WPP Scan Group got a sell. Current price, 2.71. Target price, also 2.71. So 0 expected upside.
Right. And the reasoning?
The analysts mentioned shifting marketing trends that are expected to hit revenues and also the end of their partnership with Airtel, which they think will weigh down earnings.
And how did Scan Group actually do today?
Well, aligning with that sell outlook, it was actually down 3.7% today, closed a bit lower at 2.61.
That analyst perspective is really useful for understanding the why behind some moves. Did the sources also just give the raw lists of top gainers and losers for the day?
They did, yeah. Quick look, top gainer was TPS Eastern Africa, jumped 6.5% today to 15.50.
Okay.
Other gainers included Express Kenya, Nairobi Business Ventures, Samir Africa, Total Kenya. On the other side, the top loser was Kukuzi Pluck, dropped a pretty sharp 7.8% to 365.0.
Ouch.
Yeah. And WPC Scan Group was on that losers list too, down 3.7%, along with Uchumi Supermarkets, eGads, and Home Africa.
Okay. Let's maybe pivot a bit and focus on one sector that seems really active and popped up a lot in the news highlights you shared. Banking. You mentioned an analyst report expecting more investor interest there.
That's right. One source specifically highlighted an expectation of increased appetite in banking stocks from investors, perhaps looking for capital gains as these banks keep releasing their earnings results.
Right. And we have results and news from several banks today from your sources. Let's maybe start with Standard Chartered Bank Kenya. You mentioned a detailed earnings note for them.
Yes, Stanchart Kenya. They reported their Q1 2025 results. Net earnings were actually down 13.5% compared to last year, coming in at KES 4.85 billion.
Okay, down. Why was that?
The note points to two main things. First, a small dip, 0.8% in net interest income. That's, the core income from lending minus deposit costs. They attributed this to the sort of accommodative monetary environment leading to lower yields on things like government bonds.
So making a bit less from their main lending and investment activities?
Exactly. And the second factor was a really sharp drop, 29.3% in non-funded income.
Wow, that's a big hit. What's included in that?
That's stuff like fees, commissions, foreign exchange trading income. The source said this was mainly because there was less volatility in the FX market, which squeezed their trading margins, and also just lower transaction volumes overall, hitting fee income.
Okay, so income took a hit from both sides, lending and fees. Were there any bright spots in their Q1 then?
Yes, actually. Despite the earnings drop, their profitability ratios looked better. Return on equity, ROE, that key measure of profit versus shareholder funds, that rose by 2.7 percentage points to 27.9%.
It's pretty strong.
It is. And return on assets, ROA, how well they use assets to make profit, that improved by 1 percentage point to 5.0%. So underlying efficiency seems okay.
Interesting. So lower headline profit, but better core profitability metrics. What about the balance sheet? Loans, deposits?
Well, customer deposits were down 6.8% year on year, and their loan book also shrank by 10.2%.
Lending less?
Seems like it. The analysts in the source suggested this was probably a cautious approach, maybe pulling back on lending because of concerns about credit default risks in the current environment.
Okay, being cautious. So if they weren't lending as much, where did they put their money?
They really ramped up investment in government securities that surged by 94.0%.
Shifting to safer government bonds then.
Exactly. Seen as capitalizing on the lower risk returns available there. And the analysts noted that falling yields actually boosted bond prices, so the bank managed to book KES 0.69 billion in fair value gains just from the increased market value of the bonds they held. The source called it effective portfolio management.
Smart move in that environment. And what about the quality of their existing loans? Did that improve or worsen?
It improved. Gross non-performing loans, the bad loans, basically were down 26.1% year on year. That helped bring their net NPL ratio down by 1 percentage point to 5.1%. So fewer bad loans on the books, which could be partly due to writing some off, but also probably reflect that cautious new lending approach.
Okay, putting it all together for Stan Chart. The lower earnings, better ratios, cautious lending, shift to bonds. What's the outlook provided in this night?
The outlook suggests net interest income is likely to stay a bit squeezed in the near term because of the policy environment. Loan growth is also expected to be subdued, at least short term, again, due to those credit default worries.
Makes sense.
They expect the focus to remain on government bonds in Q2, but maybe, just maybe, a gradual shift back towards more lending in the second half of the year if the broader economy starts looking better.
And dividends.
Dividends are expected to be maintained at KES 45.00 for the full year. The source thinks this will help keep investors interested, but there's a caveat.
Oh.
The outlook is described as precarious because of ongoing litigation risks, so some potential legal issues hanging over them that could impact things.
Right, a significant risk factor to watch.
Yeah.
But despite the Q1 dip and that risk, the analyst recommendation was still a BUY.
Correct. They maintained a BUY, citing the strong ROE and strategic moves. Current price, KES 270.00, target KES 323.11. That's about a 19.7% upside they see.
Okay, so seeing through the near-term challenges maybe. Now, there was news on other banks too, right? NCBA Group?
Yeah, NCBA Group reported a positive Q1. Their net profit was up 3.4% year on year, hit Shofei $5.4 billion.
How'd they manage that?
According to the news report, it was driven by a pretty healthy 20.6% rise in net interest income, different from Stan Chart there, and also a big drop, 30% in their tax expense. Those factors apparently offset a fall in their non-interest income and a rise in operating costs.
Interesting. Different drivers at play there. And what was the news about Family Bank? Something about funding.
Yes. Family Bank is apparently looking at new ways to raise money. This comes after their rights issue last year. Offering shares to existing owners didn't perform too well, missed its target.
So what are they considering now?
The report says they're looking at private placements instead, trying to get funds directly from institutional investors or maybe wealthy individuals. And if that works out, gets them the capital they need,
Yes.
they might then pursue something called a listing by introduction on the NSE.
Listing by introduction.
Yeah.
What's the point of that if they already raised the money privately?
Good question. The source notes the main goal there wouldn't be raising more capital, but rather making their shares tradable on the stock exchange. Just improves liquidity, makes it easier for people to buy and sell the shares that are out there.
Okay. So exploring different routes to get capital and improve trading. Interesting. And wasn't there some broader regulatory news affecting the whole sector?
Yes, quite important, actually. The Central Bank of Kenya, the CBK, is apparently monitoring 8 commercial banks right now.
Monitoring them for what?
Because they haven't yet met the minimum core capital requirement of $3 billion that's needed for this year, 2025. The CBK deputy governor apparently stated these 8 banks need to submit plans showing how they will meet it.
And the others are okay.
Yeah, 24 other banks have already hit that $3 billion target. And this is just a step, remember. The ultimate goal is for all banks to reach $10 billion in core capital by 2029.
Right, so it's phased increase, and 8 are lagging on this year's step. Are there consequences if they don't comply?
The source mentioned potential actions like freezing their dividend payouts or even possibly forcing mergers or buyouts to ensure they meet the capital levels. So it's definitely a serious push from the regulator to strengthen the sector's financial base.
That's significant pressure on nearly a quarter of the banks then. Okay, let's step outside banking for a moment.
Right.
What other wider market news or external factors came up in the sources?
Well, there was a piece about Standard Group, the media company. They're aiming to raise $1.5 billion through another rights issue, selling new shares to their existing shareholders.
Why do they need the cash?
The stated reasons are to settle debts and get some working capital. The CMA, the Capital Markets Authority, has approved it. They're offering the shares at $5.29 each.
How does that compare to the market price?
It's a 16% discount compared to yesterday's closing price of 6.3, so trying to make it attractive. The news report also made a point of noting that the company's liabilities actually exceed its total assets right now, which really highlights why they need this cash infusion.
Okay, so a media house needing funds, using a discounted rights issue, any major government policy shifts mentioned that could impact finance.
Yes, a really big one, actually, concerning the IMF. The Treasury has apparently decided not to include any anticipated funding from the International Monetary Fund in the national budgets looking ahead, all the way out to 2029.
Really? No IMF funding plan. Why?
According to the source, there are two main reasons. One, there's uncertainty about whether new talks would actually lead to unlocking those big multi-billion shilling loans anyway. And two, maybe more importantly, they seem to want to escape the tough conditions that usually come attached to IMF money. Those conditions led to a previous loan facility being terminated back in March.
So trying to avoid conditionality and budget uncertainty.
Seems like it. Treasury CS John Mbadi was quoted saying this approach avoids overstating the financing they expect to have, while still aiming to keep relations with the IMF cordial. It's a definite shift in strategy, aiming for more fiscal independence, perhaps.
That is a major policy change to watch. Did the sources touch on the fixed income side, bonds and bills at all?
Just briefly, turnover in the secondary bond market was down today by 12.5%. One source named the FXD1 2017-10YR as the highest grossing bond, and the IFB1 2022-14YR as the most traded by volume.
Okay. And T-bills?
T-bill rates barely moved. The 91-day and 182-day rates dipped slightly. The 364-day was flat. And the interbank rate, what banks charge each other overnight, also eased a little bit.
Right. And finally, any word on the global picture? How are international markets doing today, according to these sources?
Yes, they included some global highlights. Generally wasn't a great day globally. Major markets mostly extended losses.
Yeah.
The S&P 500 in the U.S. was down 1.2%. NASDAQ down 1.6%.
Yep.
In Europe, the FTSE 100 in the UK down 0.8%. Germany's DAX took a bigger hit, down 2.6%. China's Shanghai Composite was down about 0.9%. Japan's Nikkei was the exception, actually managed a gain of 0.5%.
So mostly down. Any reason given for the declines?
The reason cited was investor worries about fiscal stability, specifically pointing to a recent U.S. credit rating downgrade, and also fears that a proposed tax cut bill in the U.S. could make the fiscal deficit even wider, adding to debt concerns over there.
Ah, so global economic and policy worries weighing on sentiment internationally.
Exactly. Just a reminder that Kenya doesn't operate in a vacuum, you know? Global mood matters.
Okay, quite a lot covered there. So let's try and synthesize this based on everything in these sources for May 23rd, 2025. What's the overall story they're telling us about the Kenyan market today?
Well, I think the sources paint a picture of a market with some conflicting signals, really. You've got that huge surge in activity, the turnover jump, which is notable, and the NASI nudging up suggests some pockets of bullishness driven by gains in certain large stocks.
Right, but at the same time, the broader indices were totally flat and other big companies were down.
Precisely, which points to that concentrated activity we talked about. And underneath that surface, the banking sector is clearly a major area of focus and, frankly, quite dynamic right now.
Yeah, seems like a lot is happening there.
Definitely. The sources show these varied Q1 results, stand chart facing income pressure but improving underlying ratios, NCBA finding profit growth elsewhere. You have analysts apparently expecting more investor interest in the sector.
Right.
But at the same time, you've got that CBK regulatory pressure building on capital requirements, with those 8 banks specifically being watched. And you see banks like Family Bank actively exploring different ways to get funding after struggling with traditional methods. It's a real mix of opportunity and pressure.
And then layered on top of that, you have the wider context points like Standard Group needing a rights issue to tackle debt, and that really significant government decision to plan future budgets without relying on new IMF money. That feels like a major strategic pivot.
Absolutely. So putting it all together, these specific reports from today highlight that analyst expectation of continued interest in banking stocks, at least near term. For Stanchart specifically, the detailed outlook suggests they'll likely face constrained income and slow loan growth for a bit, focus on bonds in Q2, maybe lend more in H2 if things improve, keep dividends steady, but with that litigation risk hanging over them.
It really does show how many different forces are at play at once: positive signs in some areas, real challenges for specific companies, sector-wide regulatory changes, and big national policy shifts.
Yeah, what these sources demonstrate is that you can have these bursts of market activity and bullishness in specific spots, while simultaneously there are these underlying pressures and quite significant strategic adjustments happening across the board, both for companies and at the government level.
So, thinking about all that, especially the banking sector, it's fascinating. On one hand, the analysts, according to one source, expect investors to show more appetite for banking stocks, maybe chasing capital gains. But on the other hand, we know from the news today that 8 banks are on the CBK's watch list for not meeting that core capital rule, facing potential negative consequences. So here's a thought for you, the listener, to ponder, based purely on today's sources. How might those two things, the expected rising investor interest and that looming regulatory pressure on a chunk of the sector, how might they interact and actually shape the performance of banking stocks in the coming months?
That's a really interesting point. It definitely adds another layer of complexity, potential risk, but maybe opportunity too to how you view that sector right now.
Well, that brings us to the end of this deep dive, looking closely at the source material provided for the Kenyan market on May 23rd, 2025. Hopefully, breaking it down like this helps you feel quickly up to speed on the key takeaways from today's reports.
Yeah, our goal is always just to extract those core insights for you directly from the material we're given.
And if you found this deep dive useful, please do make sure you're subscribed to the deep dive on whatever podcast platform you use. It's honestly the easiest way to make sure you catch all our future deep dives, where we unpack different topics using the sources you bring us.
And don't forget, for other updates or content, you can follow our channel on social media. All the links you need are right there in the description for this particular deep dive.
Thanks again for joining us today.
Until next time.